Hi guys, June 2nd here, 2013. It is Sunday afternoon. Thank you for joining me here on the podcast Through a Trader's Eyes. And we're probably not going to be able to get to everything today because there's a lot of stuff going on. But obviously, through the rest of the week, we'll try to keep you updated and probably do more frequent podcasts over these next few days because we've got a jobs report coming out on Friday. Of course, we had a big reversal. The Dow was down about 209 points this past Friday, and we had the infamous Hindenburg omen. And if you've never heard that before, maybe you should disregard it. I don't know. We'll talk about that in just a minute. But here's a picture of the S&P, and as we always do, we start out just showing that. And we've been in this uptrend. We broke it a little bit in the middle of April, but it's been pretty consistent. And I had these green arrows on the last podcast and talked about the fact that hopefully we would get down to this level, maybe even down to the 1600, just because that was the old breakout at the beginning of May. And if we did, that'd be a better place to buy, not only because you would see the 50-day moving average comes into play at that point. And then, of course, just looking at technicals here, the next kind of line in the sand would be somewhere down in here at the 100-day moving average, which would be somewhere around, let's call it 1550 or so. So those are some, I think, areas of support, and I think it's hard to say if it will get to that point or not. Every dip has been bought. Now the dips that have been bought haven't been that severe. We did have a couple of nasty down days in April, and then they reversed pretty quickly. So let's see. We're getting more economic data out of China. We're getting more economic data out of the U.S. And the stock market right now and the bond market are acting as if the Fed is going to start their tapering process. Which, for those of you that don't know, the Fed is purchasing $85 billion a month in bonds. I think half of it's mortgage bonds, mortgage-backed securities, half of it treasuries, and they have hinted around, some of the Fed governors have hinted that perhaps they would slow that process down a little bit, start taking their foot off the gas. I think there's a bunch of evidence that does not support that, and we'll get into that in just a minute. But right now, the stock market is acting as if there's accelerating growth, not only in the U.S. but around the world, because cyclical type stocks are doing very well. And the more conservative, low volatility stocks are going down right now in the last few weeks. And remember, those were the kind of the leaders, and now they're turning into the laggards. And so from looking at that from the surface, you would say, well, if the cyclical things are leading, then that should be pointing to a stronger economy. And meanwhile, the bond market's selling off, so people believe, hey, if the Fed's going to taper because things are so strong, we should be selling bonds, anything that looks like a bond, income producing, and move into just go-go tech stocks or very cyclical type names. Okay, so here's the first picture talking about the Fed and what they might do. And it's no secret that the Fed's favorite indicator is the personal consumption expenditure deflator. I know it sounds real exciting, but if you're really cool, you call it the PCE deflator. And this is it's an inflation measure, and it's the year-over-year change that you're looking at in percentage terms. So you can see back in the 70s it was at 10%, and then of course it's been falling ever since, and it started to reaccelerate, in the 2003 through 2009 time frame, 2008, I guess, not 2009, but 2008. So it was going up, but it's always been around 3%. We just haven't had this inflation that a lot of people have worried about. And if you zoom in here on the right side of the screen, you can see that it's pointing down, and not only is it pointing down, but it is now at its lowest level, going all the way back. This chart goes back to 1960, and I think that's as far back as they've kept it. So we're at the lowest level ever on this. Now, you may say, well, okay, what does that mean? Well, it means that if this is the Fed's favorite inflation indicator, and inflation is at its lowest level ever, according to what they like to look at, how on earth are they supposed to go and start tapering and raising interest rates? Now, could they do it to have some type of symbolic gesture, where they drop it from 85 billion to 80 billion, and yet they're not really doing anything because, 5 billion here, 5 billion there. And remember, that's per month that they're buying. So if they dropped it to 80 billion, that's still a huge, huge number, but it would show that they're starting the process. Could they do that? I guess so. But for the bond market and the stock market to be acting as if inflation's right around the corner and the economy is rip-roaring, I don't see it. And this is just one thing that we're looking at is this PCE deflator. It is going the opposite direction of what the Fed would need, it seems like, to raise interest rates. Here's a second picture, which we made up on Bloomberg. Citigroup Economic Surprises Index. And this is something that essentially looks at all the different economic releases, which there's probably 20 or 30 or 40 or 50 every week, just depending on the week. And they look at them and see how many are beating expectations, how many are coming in lower than expectations. And for a while, in the early part of the year, and I mentioned this in the podcast, that there was a lot of economic reports that were coming in better than expected. And they weren't great, but they were beating expectations. That was here. But lately, it's been going this direction. And so again, what that tells you is most of the data that you're hearing about, whether it's manufacturing data, jobs data, whatever it might be, inflation data, housing data, on whole, these things are coming out a little weaker than they were 3 months ago. There's not as many beats. It'd be like the S&P 500. If you looked at the 500 companies reporting earnings, most of them were beating those earnings estimates. And now what you see is most of them are not. And I'm just using that as an example. But this takes all the economic reports into consideration. So once again, wouldn't the Fed need to be seeing this plus inflation turning up? I mean, we don't see that. What we have is almost deflation, but certainly a lack of inflation. And if you're somebody that goes to the grocery store, maybe you're saying, well, Karl, I don't see prices just plummeting there. No, but look in the bigger picture. Inflation is a basket of things like commodities, which a lot of commodities have been falling about 25% as a basket over the last year and a half, 2 years. Gold, right? Don't you think gold isn't? I don't think gold's an inflation hedge, but it seems like the rest of the world thinks that gold is this inflation hedge or a good proxy for inflation. It's going down, right? Here's that picture of gold. It's going down. So, you start, and then wages. We still don't have people, even though people are spending money right now, they're not making any more than they were. They're actually, their wages are going down. I mean, when you compare wages a year ago, 2 years ago, it's going the wrong direction. So while the consumer's not being hurt on the inflation side necessarily, they're certainly not making any more on the income side. And so again, when you put all that together, I don't see how the Fed can go and start raising interest rates. Now, remember, there's two different things with interest rates, right? Interest rates, the long-term interest rates, which are 10-year rates, this is what they've been doing. You notice they're still lower than they were, a year ago, but they've had a spike up in the last couple of weeks based on this tapering. They had a kind of big reversal on Friday as the stock market fell. It's kind of a flight to safety. But here's the deal. If this is long term, so the Fed can only control this so much because they can control this by how many treasuries they're buying. And so they control that, but they also control, money market rates, essentially, CD rates, very short-term interest-bearing rates. And did I just say interest-bearing rates? I guess all rates are interest-bearing. Anyways, the bottom line is short-term rates. They control those as well. And they've already said until they see unemployment drop to 6.5%, inflation get up to 2.5%, they're not going to raise short-term rates. So what's happening is the yield curve, which is short-term rates and long-term rates, is steepening, signaling a healthy economy. I just think these rates have gone up too far, too fast, and that the data that's come out lately does not justify this. Now, we've been in this kind of channel here. So, again, as the stock market's been going on a channel, should we expect this downdraft? Perhaps. And I think it's obviously coinciding with the fact that the stock market had this, reversal, and I'll zoom in a little bit. had this reversal, and it is overbought. Stock market is still overbought. It's been overbought, but it seems like it should settle in a little bit. June's historically been a fairly weak month overall when you look at all the months. So I think it's likely we do get a little pullback and rates do come back in a little bit. But any piece of data that suggests the economy is getting stronger, the market's going to pay attention to that, and stocks will go up and bonds will go down. So be careful, because the lower volatility things right now have been stocks, not what the traditional conservative income-producing investments are. Those things have been a little more volatile lately. I just don't believe that we know who Ben Bernanke is. He's already told us. He's demonstrated it. Given that, it doesn't seem like he's going to all of a sudden change what he believes in and start tapering. By the way, let's not forget, Ben Bernanke spoke on May 22nd, okay, just a couple of weeks ago, and he said premature tightening would endanger the recovery. And he just said it 2 weeks ago, and yet the market is acting as if he's going to do it tomorrow. So, there's talk that seems like consensus is they're going to do something in September and start letting their foot off the gas. I guess it's very data dependent. If something accelerates between now and then and the data starts coming out better, maybe he will. But right now, it seems like a very mixed bag on the economic front. So I don't see them doing the tapering. But let's think about this. The stock market is off to a good start in 2013. And, of course, it's only May. The market could give back all of its gains in the next 3 weeks. It did that in 2011 pretty quickly. But if you look at the years that are similar to 2013, 1995 is the most correlated. It's the one that's getting compared to the most. 1995, and I'm not going to show it to you. It looks just like this, which is 2013. And the question is, what does the rest of this year look like? Right? We're only here, and we have out until, just to put it in perspective for you, until December. A lot can happen between now and then. We know that. And I think market could do this, market could do that, it could do this and that and this. I don't think it'll ever do that. Can't do that. But it will. It's not going to continue on this pattern, I don't believe. But if this was 1995, that's exactly what it would do. It would continue on this exact same pattern. 1995, the market went pretty much straight up. It just went like this, and it just kept going. And so if you look at 1995, which was, by the way, from about January through May, was like 96% correlated to this year. It's very, very weird. And the rest of the year, it went on to make basically double its gains and ended up about 34% up for the year. And there really wasn't a major pullback at all. In fact, I don't even think it had a 2% correction that year. But when we look at all the years that have started out similar to this, on whole, the market has made more money by the end of the year. Now, it doesn't mean it went up in a straight line like 95, but it has gone up. So if history is to repeat itself, there should be more gains to come. But there was several of those years, all the way back to 1950, 1971, 1975. Those had 9 to 11% corrections before they went up. And so they did make money the rest of the year, except for, I think, 70, 75. A couple of them were flat. But basically, they had some nasty corrections in between, and then they went on to do okay. But overall, it's been a pretty good, if the market started out this strong through May, it generally will have a few more gains. So it may not be over. Of course, you start getting into that type of seasonality type stuff, and you rely on it too much, you could get burnt. So if you just in your mind say, well, this looks like 95, it smells like 95, so surely it's got to be like 95, and it's going to keep going up, that's when you may get hurt. 95 was very different from from 2013. In 95, remember what happened in 94. Interest rates had spiked, the market didn't do anything. Well, this year, in 2013, the stock market had already been doing well. So it's coming off of a pretty good year. So don't necessarily look at that, but just to give you some flavor for what what markets have done in the past, 2013 is starting out similar to 1995. And don't forget, 95 was the very beginning of one of the greatest bull markets, if not the greatest bull market in history, 95 to 2000. That's when things really got going. Well, this particular bull market from March of 2009 is obviously over 4 years old now. All right, I'm just going to wrap up with this. And by the way, just briefly, watch the market. There's going to be some data coming out over the next few days to see if it pulls back, if this could be a perfect buying opportunity right at this level. So just play it pretty flexible the next few days, because even though I'm pointing for a sluggish economy and rates to still stay kind of in the neighborhood they've been in over the past few months, the market is telling you something different, and we want to invest based on that. We don't want to necessarily just disagree with the market as the cyclical things are going up. So you have to be flexible. Just keep in mind the backdrop that we're in. But let's talk about the Hindenburg omen. This is something mentioned, a couple of years ago. And it's when all these, to me it's kind of goofy. It's when all these things happen at the exact same time. For example, you have to have, you look at the New York Stock Exchange and you have to have a bunch of new 52-week highs at the same time that there's a bunch of new 52-week lows. The New York Stock Exchange 10-day moving average has to be going up. The McClellan oscillator, which is a technical indicator, has to be going down on that day. Anyways, it's all these things together, and people believe that the stock market should fall based on that. So the last time we've heard about this Hindenburg omen, the market's gone up, not down. So, I don't know. Again, if you could tell me 10 different combinations of things that led to market sell-offs, it's kind of like saying if you wear blue jeans on Tuesdays an odd number of years and you owned Apple, you made money. Well, there's a lot of coincidence in there, right? So that's what the big chatter was on Wall Street the other day, was the Hindenburg omen. All right, I got a lot of data coming out in the next few days. Again, stay flexible and keep the income coming in, but pay attention to how people are treating those income-producing things right now, because they're in the last few days they've sold off. However, the stock market made a pretty big reversal on Friday on pretty heavy volume. But even so, think about time frames, because regardless of what happens here in the short term, we're still in a bull run. So pick your spots, and for the cash you wanted to get invested, and maybe the money you've taken some profits on some things, look to get that money to work, because this bull market I don't think is over based on the medium term. Even though and I think this is kind of a Goldilocks, because the economy is soft but not horrible. And we got housing that's good and autos that are good, but we have this inflationary stuff that's not showing its rearing its ugly head. I think that combination is actually good for the stock market. I just think the bond market and some of these things selling off as they have is kind of a mistake. All right, have a wonderful weekend, and we will talk to you soon.